Number two, it means that there's going to be a lot of money sloshing around. Number three, it means the prices of everything is going to go up.
Yeah. Well, I mean, when I think about the money supply, it's like, okay, let's not forget, and I talk about this all the time when I talk real estate investing and I talk, having a longer term time horizon, right? I don't know what's going to happen in the short term. We were all speculating, right? But I can, when I look at a 10-year time horizon when we buy real estate, I'm like, man, guys, let's not forget the federal government has printed 80% of the money supply since 2020. And a lot of that money is on the sidelines because of the high rate environment. You can get, you can invest in government bonds. You can get 4.5% risk free in a CD right now. So a lot of that money is on the sidelines. But to me, when I think about what you're saying right now, and we need to let inflation run, we need to, increase GDP. I think the most common thing I think of is, well, we just need to reduce interest rates.
Right. And that's coming. And that's coming. I want
And
to go.
why has it not come? I mean, we're looking at 40 months now. And if you would have told me this 40 months ago, that we would have doubled interest rates for 40 months and a lot of the real estate, at least the major markets, would be relatively untouched. We're seeing some discounts out there in the marketplace, 10, 20%, but nothing crazy. I think that's a sign of how strong the fundamentals are behind real estate. But what needs to happen to lower this interest rate environment?
Well, there's two things that need to happen. So number one, we have the Fed
Okay.
headed by Jerome Powell. And so Jerome Powell says, look, we're supposed to be independent. Our goal is to keep employment full and inflation low. And if we lower rates, so what happens is this iPhone, whatever, it's like $1,400. It's expensive, maybe. If this price got dropped to $500 for the next month, they would sell more iPhones if it's cheaper. So we buy money. People don't really think about this. You probably think about it like this, but we buy money. What's the cost of buying money? It's the interest rate. So if the interest rate goes down, cheap money gets cheaper, we buy more of it, right? And so what happens is if they lower the interest rate, money gets cheaper, people buy more of it, and that's going to put more money into the system, which then pushes inflation up. But the Fed is supposed to keep inflation down, and they want to keep employment full. So unemployment rate is very low, historically really, really low. So that's doing really well. And he's holding inflation at bay. So Jerome Powell's like, we're doing our job. Now, the Trump administration, that's the fiscal. So we have monetary, the Fed, and we have fiscal, which is the government. The government's like, hey, we want to juice this thing up. Trump's obviously a real estate person. He understands low rates. So he's been hammering Jerome Powell, calling him too late. You're always behind the curve. You're always too late. Lower rates, lower rates. But Jerome Powell's like, no, I don't want to do it. So what's going to cause that to change? I think that's the question that you asked. Well, there's two things. One, Trump has been trying to berate him, trying to bully him, if you will. Doesn't seem like Powell's going to cave to that. The jobs reports, remember, they're looking at unemployment and inflation. The jobs report just came out and got revised way down. Trump was so mad, he's firing the head of the BLS, the Bureau of Labor Statistics, that publishes those numbers. And so, okay, maybe we change the unemployment outlook. That could cause Jerome Powell to cave. Or maybe Trump elects like a shadow Fed chair. It looks like probable. They were trying to drum up charges that Powell has completely mismanaged a renovation of the Fed building. Trump even went and did a tour of that like a week ago. And maybe we can get him out that way. Maybe we elect this shadow Fed chair. We can circumvent him, but he's gone. He's gone in 6 months anyway.
Mm.
And the president elects the next one. So
Mm.
what I'd say is a couple things. Number one,
And that term is up. Jerome Powell's term is up December of this year. Is what you're saying.
yeah, and he'll be replaced early next year.
Mm.
And it looks like right now, if I had to put some money at this point, this guy Pulte, who's head of the FHA, is
Mhm.
probably a likely candidate to come over.
Head
Now,
of the FHA.
yeah, so there's a couple things that are important for us as real estate investors to understand. Is number one, he's looking at housing. He understands that we need low rates to get the housing market going again. So he's a low rate guy. Number two, he said that he instructed the FHA to consider Bitcoin holdings as part of your credit worthiness to buy homes, which is really big. So that looks like probably the most probable choice at this point. And so that means lower rates are coming when. So either one, when he gets replaced, but also, like I said, Trump is trying to sort of circumvent that. But it also looks like I said, per these job reports numbers coming down, it looks like probably in the next meeting, we might see a little bit of relief. But Trump wants them down to like 1.5.
Yeah. Now, I know there hasn't been like major talks in the marketplace about, us being in a recession, but things haven't been easy for a lot of business owners, entrepreneurs, real estate investors over the last 36 months. Liquidity is an all-time low. If you think about how most Americans re-up on liquidity, is by refinancing their primary home, which is their for most Americans, the biggest asset they ever own. And it's the easiest path for an everyday American to become a millionaire. And if you think about it, even if you're a doctor attorney making 400K, 500K a year, you still have kids that are probably in private school, expensive car payments, an expensive mortgage, and you still need to re-up on liquidity. And no one's been able to refinance in the last, 36, 40 months because of the high rate environment. For one, why are you going to refi to a higher rate? But number two, values haven't gone up to where you can pull cash out, right? And so I think because of that, liquidity is an all-time low for Americans. And then you're seeing like, telltale signs in the market. Like right now, I'm selling my old boat. Horrible time to sell a boat. Great time to buy a boat. A lot of people overpaid on all these yachts back in 2020, 2021, coming off of the pandemic. We saw high prices. People overpaid for boats then. And now with things kind of tightening, cash flow gets low for a lot of business owners. What's the first thing they're going to get rid of? The boat's a luxury, right? And so you're seeing a fire sale of all these expensive yachts right now. I was able to just buy a $3.5 million yacht in 2021 for 1.3, 4 years old. That's almost a 70% discount. And people are just taking baths right now on these expensive boats. And so, that's a telltale sign of what's really going on in the economy. And so when I think about, okay, like unemployment's at an all-time low, right? Also, minimum wage is at an all-time high. I was at In-N-Out last night, and I was waiting for my order, and I'm talking to the people there. They start those guys at $22 an hour.
Yeah, it's crazy.
That's more than 3 times I was making when I got my first job at 16 years old. And
Yeah.
so, and payroll's gone way up, right? And then in addition to that, we've been in a high rate environment. It's harder to borrow money. And so it puts a lot of pressure on a lot of business owners.
Yeah.
You know?
So I'd say a couple things. So one, you said liquidity is at an all-time low, and you're specifically talking about the residential sort of home market or just real estate market overall in the United States.
I'm talking about for retail investors.
Right.
So any retail investor that's making anywhere between 100K and 500K a year, they're low on liquidity right now. I'm
Right.
talking to a lot of investors and investors. That's like, dude, liquidity's low right now.
You're right. So I love to look at liquidity, but I look at global liquidity.
Okay.
Because global liquidity is the amount of money in the system. And it's not just the amount of money, it's the availability to add more money because of credit, which is a bigger conversation. We can side hold that, but a lot of people don't really understand this, but we're in a debt-based monetary system. So what that means is that money is created through debt issuance. And so when money is created through debt issuance, the dollar becomes the liability, the debt is the actual asset there. And so if you understand the mechanics of that, the money supply always has to grow. But let's sidebar that for a minute. So I want to look at the total amount of money in the system as well as the availability of credit to create more money. Now, I look at this globally because most assets, S&P 500, the Mag 7, Bitcoin, those are global assets. And so we can see that across the board, assets are at all-time highs. S&P, NASDAQ, Bitcoin, they're all at all-time highs because global liquidity is an all-time high. Now, the Fed and Europe, the ECB have been pretty tight, but Japan and China are blowing it out of the water. So globally, there's a lot of liquidity. Now, back to the United States and the rates. So there's a couple things that are true about that. So number one, to your point, nobody wants to sell or refinance because rates are super high. So there's 2 things that are in the works right now. You've been seeing they're floating, removing the capital gains tax on houses. So that's part of the plan to remove the capital gains is so that they can unlock this log jam in the real estate market. So if I'm an old person, right, my family's moved on, I'm in this big house, I don't want to sell because I have this big cap gains expense, and I don't want to 1031 into another building. So if they remove the cap gains tax, hey, I'll sell the home, I'll move on to a different home. So that's number one. And then number 2, the rates are coming down. I would say while that is there and by the way, your boat's beautiful. I saw pictures of it.
Oh, thank you, my man.
Good job on that. Good job on that.
We'll have to get you out there sometime and shoot. Maybe we should have done this podcast on the boat, man.
But what I want to say though is for people that are looking ahead, hopefully you mentioned like 5-year, 10-year timeframes. People that are looking ahead, rates are coming down. Within the next 6 months, they're going to be slashed drastically. And so if I'm a multifamily investor,
hold on. When you say that 6 months from now, they're going to be slashed drastically.
Yeah.
What kind of when you say
Trump
drastic,
wants
what
them
does that
down.
mean
Trump
to you?
wants them down 3 points.
Are we talking 50 basis points, 75 basis points?
Well, I mean,
in
Trump,
6 months.
Trump wants them down 3.5 points. So he wants them down to 1.5%.
In what kind of time horizon?
Yeah, I mean, we'll have to get the new Fed chair and what the new dot plot is, but I would imagine probably by the end of next year. By the end of next year, probably we're at that range. So what does that mean? Well, that means that
that's a bold prediction.
I might want to buy this multifamily property now that's run on a CapEx or cap rate, I should say, or a house, knowing that in a year from now I could refinance it and the valuation is going to go way up. And so we can use this to our advantage if we understand sort of where we're at. So to your point, liquidity is low. Liquidity isn't low. The banks are lending. The problem is the rates are high, and so it's hard to make deals
Totally.
work.
And we're in the trenches every single day, and so I forget that it's not supposed to be easier right now.
Right.
I forget that because we're in here building it, and we've figured out a way to continue growing, and we're playing offense. But you just got to take what the defense given you, right? And so it's like, okay, we're in a higher rate environment, but on the flip side, when we're in a low rate environment, there's a ton of buyer demand. It's hard to find deals.
Right.
I was like, well, right now we can find deals, and as long as we stay, obviously disciplined with our buy box, buying a great location, we can never replace location. We got to be able to buy below market value, and we have to have a clear path to add value. If we have those three things, as long as we have a long time horizon, it's hard to lose.
Yeah.
You know,
And there's a market equilibrium. So back to your boat, right? So you bought this boat for 70% off of what it was a couple years ago, but to sell the boat you have now, you're also
exactly.
taking a discount. So it's like my boat isn't worth as much, but I can buy a new boat that's not worth as much either. My house is at an all-time high, but when I sell my house at an all-time high, I have to buy another house at an all-time high. So there's always like this equilibrium. The market's pretty efficient in that manner. So it's like there's no the arbitrage would be the time. Sell at an all-time high or sell now and then buy a year later, right? And so we can arbitrage time, but currently the market's pretty efficient in that manner. So the market still works.
Yeah, and I think when I think about what you're alluding to with the rate environment, I really feel like the opportunity for those listening to this podcast right now that are looking to get into a deal, looking to play a little bit of offense. I think there's a good opportunity in the next 6 months because if you're saying is true and actually plays out, and we do see significantly lower interest rates 6 months from now, and especially 18 months from now, well, guess what? A lot of these buyers that are on the sideline are always going to be
Right.
in the playing field.
And you
And
want to
it's
front run that.
yeah,
You want to get to where the puck is going to be, right? So like knowing, okay, in a year from now, the rate's going to be way lower. I might want to move into position on this real estate deal within